Hi, Scott. How are you?
Have we seen the worst? I'm good, thank you. Have we seen the worst of this tech sell-off?
Possibly. I mean, we've had a lot of technical damage due to macro-related issues, technical issues. We're still expecting strong earnings growth this week, however. So whether this tech sell-off continues, I think really depends on how the mega cap tech reports. I think valuations have definitely been more reasonable now that we've had a little bit of a correction. I think most importantly is how stocks react to the earnings news. If we have inline earnings guidance and stocks sell off, I think there's more for tech stocks to go down from here.
I mean, it's not like tech valuations have corrected all that dramatically in the pullback we've seen in some of these names. So I'm not so certain that issue has been taken care of if one believes that an issue existed in the first place.
Well, it depends. Not even if you look at the Magnificent Seven, not all names are the same. For example, names like Google and Meta, which we think our valuations are pretty fair, right in line with 10-year averages. Earnings have kept up, so stock prices have come down, means valuations are in line. On the other hand, you have names like Microsoft and NVIDIA and Apple where valuations are still elevated. So to us, it really depends on how the reactions are, more so than what the valuations are at this point.
But if you think Microsoft, Apple, and NVIDIA valuations are still elevated, those are within your top 10 holdings. So what does that mean for how you're thinking about your own portfolio?
We have, in the last couple of weeks, actually trimmed some of our tech exposure just because of the fact that the sizes have gone so large. We're still bullish. Near term, I do think there's going to be a lot more choppiness. Longer term, I still think the earnings growth is there. There's long runways for the AI industry. And I do think that the earnings growth is going to keep up. Although I do recognize that comps are going to get a little harder. So from that perspective, I think near term, you're going to see a lot more choppiness. Longer term, the businesses are still intact.
But how much of that trimming, I get portfolio management, I hear that a lot. But how much of that had to do with the mere fact that you think that some of these stocks, if not all of them, just simply went from, up and to the right, some of which wasn't necessarily based on full fundamentals?
Well, ultimately, what the market cares about a lot is just earnings growth. With NVIDIA, for example, we've had 2 years of triple-digit earnings growth. We can't expect companies like that to continue to deliver that type of earnings growth. But can we grow in the mid-teens in terms of earnings growth for the next couple of years? We do believe so. And if that's the case, 15% per year over 5 years means your earnings double from already very high levels. So, trimming of stocks is something that we do from a portfolio management perspective, but we still like these companies and we still think they're going to do well relative to the market.
If you're looking at earnings growth as a key metric then of how you're viewing where these stocks are going to go from here, then I'm assuming that you must be a little more defensive perhaps about where you think Apple could go.
We are. So out of the 7 and perhaps more appropriately, the fabulous 5 now, Apple is the company that has lower earnings trajectories, more sort of mid-single digits rather than double digits earnings growth. And for that reason, we've actually trimmed some of our Apple exposure as well. But having said that, I do think the company is going to have its AI initiative a lot more formalized and concrete over the next couple of quarters. I think the company can leverage over its, over 2 billion of its devices that are active. So I think there's a lot of levers that Apple can pull that can make the company, the stock, still a very good long-term investment.
What's the largest mega cap position you have? If you suggest that you've been trimming a lot of these names ahead of this pullback, what's the largest position you hold, and why is it the biggest?
Microsoft is still our largest, and the reason why we like that company is simply by the fact that it's so entrenched in our day-to-day lives in terms of enterprise and just the consistency and the defensiveness of the business. So while valuations are elevated for a name like Microsoft, we think that the premiums that investors are paying for it is reasonable.
The idea of low, I'm going to take you back, let's say, I don't know, 6 months, 4 months. let's go 4 months. The idea of lower interest rates at some point this year, how much do you think that had to do, if at all, with the run that we saw in these mega cap names? And then if I take that off the table from you, what is it going to mean for the next 6 months, let's say?
Fair question. We were non-consensus in terms of our interest rate outlook. We thought that the Fed was not going to do what the market had expected in terms of a percentage cut in rates. So we were thinking 1 or 2 rate cuts this year. We think, honestly, earnings growth is going to be more important than whether the Fed cuts or not. And frankly, given the recent economic data that we're seeing, I think it's reasonable that the Fed doesn't become too aggressive in cutting rates. So from that perspective, whether the Fed cuts or not, we still think these are good investments because of the fact that earnings growth is going to be so strong.
Even with no cuts at all?
Correct.
King, it's good to talk to you. We'll see you soon. That's King Lip.